Silver just did something it has not been able to do in the entire working lifetime of most people watching this. It climbed above a ceiling that has held it down since before many of you bought your first home. And almost no one on the financial channels is telling you what that actually means. They are talking about the day. They are talking about the week. They are not telling you about the long, quiet, generational thing that just changed underneath the noise. If you own silver right now, or you have thought about it, I need you to sit with this for a minute, because it matters more than any single price move. This is not about what silver did in the last few sessions. It is about a warning the metal just sent that takes decades to build and only shows up once in a lifetime. By the time we are done, you will understand what a long base actually is, why the biggest banks would rather you never learn it, and why the length of the wait is the whole story. So let me give you the fact that started all of this, and it is not a number on a screen. It is a piece of history. Silver reached a famous ceiling around $50 back in 1980. Then it collapsed. And here is the part nobody frames for you. It did not get back to that ceiling for about 31 years. It touched it again around $49 back in 2011, and then it fell away all over again. From that first peak in 1980 until just recently, the metal spent roughly 45 years trapped beneath a single price. 45 years. That is the longest base in any major market I can point to. And that is the warning in the title. Not a crash, a base. Now, I want to make sure you understand what a base even is, because this is the idea the whole video turns on, and it is the idea the trading desks are happiest for you to never think about. A base is a long, boring, sideways stretch where a market goes nowhere. Buyers and sellers grind against each other year after year, and the price just chops in a range. To most people, it looks dead. It looks like a market that failed. But underneath that boredom, something is happening. Every year that passes, weak holders give up and sell to stronger ones. The people who panic are slowly replaced by the people who will not. The supply that was hanging over the market gets absorbed, and the longer that goes on, the more powerful the eventual move out of it becomes. That is the one rule I want you to carry out of this video, because it is the spine of everything I am about to show you. The bigger the base, the bigger the move. A market that consolidates for a few months can break out for a few months. A market that consolidates for a few years can run for a few years. So what do you suppose a market does when it consolidates for the better part of half a century? That is not a small coil. That is the biggest spring I have ever seen wound in a metal, and it just released. Let me put a face on those 45 years, because that is a long time to say out loud and still not feel it. Picture a man who bought silver near that 1980 peak. He was in his 30s. He had read the same things you have read. He believed the dollar was in trouble, and he was not wrong about the long arc of it. And then the market turned on him, and he spent the next chapter of his life underwater. Through his 40s, his 50s, his 60s. His kids grew up, he retired, his friends laughed at the coins in the safe. 31 years in, the price finally kissed where he bought, and then it fell away again, and he waited more. That man had to reach his old age before the metal he bought as a young man finally, durably, climbed above where he started. That is what a 45-year base costs the people living inside it. And that is exactly why almost nobody has the patience to be positioned before the move. The wait breaks them. Now think about who profited from that wait. Every year that silver sat dead beneath that ceiling, the story on the financial channels was the same. Silver is a relic. Silver is for cranks. Gold, at least central banks buy, but silver is just an industrial afterthought. That drumbeat did not come from nowhere. A metal that everyone has given up on is a metal that trades cheap, and a metal that trades cheap is a metal the desks can accumulate quietly, while retail investors are taught to sneer at it. The big banks do not fear a market that is falling. They fear a market that is coiled, because a coiled market is one they cannot keep cheap forever. The long base was never proof silver was worthless. It was the accumulation. And here is the second half of what makes this base different from any short pullback you have watched. It is not just long, it is real. Underneath the boredom, the physical world kept getting tighter. The world has run a structural silver deficit for several straight years now, 6 years running by the counts I trust most. That means every year the world uses more silver than it digs up and recycles, and the difference gets pulled out of above-ground stockpiles that are not infinite. And unlike gold, silver gets used up. Gold is hoarded. It sits in vaults and gets counted. Silver gets burned. It goes into solar panels and electronics and medical devices in tiny amounts, a few grams here, a few grams there, dispersed so thin across so many products that recovering it is uneconomic. It is spent and gone. So the base was not just a market resting, it was a market being drained. I want to pause here because this is exactly the point where I need to speak to you directly about your own money, and not as a pitch, but as protection. If you are a retiree, or you are close, and you have $100,000 or more sitting in a 401k or an IRA, the thing that should worry you is not missing the upside on silver. It is that everything you built is sitting in paper assets that all depend on the same system holding together. Here is something most people never find out until they go looking. There is a completely legal way to move a portion of the retirement account you already have into physical gold and silver, the real metal, without triggering taxes and without paying an early penalty. It is called a self-directed precious metals IRA, and the central banks of the world are effectively doing the same thing at a record pace right now, buying more than 1,000 tons of gold a year, moving out of paper and into metal they hold themselves. This is not just for insiders and institutions. If you have 100,000 or more in any retirement account, this is available to you too. I put together a free guide that walks through exactly how it works. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Look it over and then come right back, because the history I am about to show you is the reason this matters. Because here is the part that actually changes things, and almost nobody gets to it. Silver has done this before. Not the ceiling, the base. And when you understand what happened the last time a metal broke out of a long consolidation, the 45-year base stops looking like a warning of danger and starts looking like a warning of scale. Go back to the 1970s and look at gold. Gold had been pinned by government decree at $35 an ounce for a generation. Held there, fixed, boring, dead. A long, flat base enforced by law. And when they finally cut it loose in the early 1970s, gold did not rise politely. It went from $35 to over $800 by the end of that decade, multiplied many times over. The longer the price had been pinned, the more violent the release. And even inside that run, gold did something that teaches you everything about how these moves punish the impatient. In the middle of that great bull market, gold fell from around $200 down toward $100. It nearly cut in half, in the middle of the biggest run of the century. How many people do you think sold right there, convinced the party was over, convinced they had been fools? And then, from that halfway low, gold multiplied about 8 times into its 1980 peak. The shakeout was not the end. The shakeout was the toll you paid to stay on the road. And the desks know that. They know a scary drop inside a bull market is the single most reliable way to separate a nervous holder from his metal. So when I look at silver breaking out of a base that is not 1 decade long, like that gold example, but closer to 4.5 decades long, I do not think small. The bigger the base, the bigger the move. This is the biggest base. That is the entire argument of this video, and it is why the length of the wait, the very thing that broke that man and his safe full of coins, is the thing that should have your attention now. The wait was not wasted time. The wait was the setup. Now let me be the honest voice in your life that the promoters will not be, because this case comes with real caution attached, and I am not going to hide it from you. A breakout from a long base does not mean a straight line up. It never has. The same silver market gives you gut-wrenching drops on the way. Remember, in 2011, the exchange itself raised the cost of holding silver several times in a matter of days, and the price fell around 30% almost overnight, even though nothing about the metal in the ground had changed. They moved the cost of holding, not the value of the metal, and shook a fortune of it loose from nervous hands. That can happen again. So understand what I am telling you. This is a case. It is not a guarantee, and it is not personal financial advice. Silver is volatile. If this base breaks out the way long bases tend to, it will still terrify you at least once on the way. Which brings me to the most important practical thing I can say about your own position, and it is not about buying. It is about surviving your own success. Own the metal, not a paper promise. When you hold a paper claim on silver, you are trusting the same institutions that profited from the long base to make you whole in a panic. And in a real squeeze, there are far more paper claims floating around than there is metal to satisfy them. Second, size it so a drop can never force your hand. The man who gets shaken out is almost always the man who bought too much, too fast, with money he needed, so that a 30% scare turned into a forced sale at the worst possible moment. If you own it in a size you can sit with through a shakeout, you are the strong hand the base was training all along. And whatever you do, do not sell into the shakeout. That is the moment they are built to create. Let me widen the lens, because silver has never been just a metal. It has always been tangled up in a political choice, and that history is part of why this base ran so long. For generations, whether silver counted as real money or was quietly demoted to an industrial afterthought, was fought over by governments and the powerful interests around them. Whether silver is money or merely a commodity has been argued in this country for well over a century. That is not trivia. It tells you that the suppression of silver, its long relegation to the industrial afterthought, was never purely about markets. It was a decision, and decisions can reverse. And ask yourself why the central banks moved when they did, because it points straight back to the base. After the foreign reserves of a major power were frozen a few years ago, the world's central banks looked at their own vaults full of paper claims on other countries and drew a very simple conclusion. Gold you hold yourself in your own vault cannot be frozen by another country. Silver in your hand answers to no one. That is why central banks have bought more than 1,000 tons of gold a year for 3 straight years running, roughly double the pace of the decade before. They are not chasing a price. They are choosing metal they control over paper they merely hold. And when the largest, most conservative buyers on earth quietly change what they trust, that is not a trade. It is the ground moving. The long base in silver ran during the years when everyone believed paper was safe. That belief is exactly what is now cracking. Here is another thread the desks would rather you not weave together. For years, the textbook said gold and silver should fall when real interest rates rise, because a bond that pays you a real return is the true enemy of a metal that pays you nothing. That relationship held for decades, and recently it broke. Metal has climbed even as real yields stayed high, and the honest explanation is physical demand. Central banks and real buyers taking metal off the market regardless of what the interest rate math says they should do. When an old, reliable relationship quietly stops working, that is not noise. That is the sound of the ground shifting under the people who built their careers on the old rules. And notice what silver is doing relative to gold right now, because this is the tell for where we are in the cycle. Gold led. Gold made the record highs first, near $4,000, and the financial press finally noticed gold. But silver has been the faster mover more recently, closing the gap, catching up. That is the classic late cycle signature. Gold moves first because it is the reserve asset the big institutions reach for. Silver moves later and harder because it is smaller, tighter, more explosive, and it needs the crowd to wake up before it runs. The gold-led, then silver catches up sequence is exactly the pattern that has marked the powerful phases of past metal bull markets. Silver is not lagging because it is weak, it is coiling before it leads. So let me say the thing plainly, the thing that ties this whole video together and that I promised you at the start. You are early, not late, early. The smart money, the central banks, the people who move 1,000 tons of metal a year, they already see it. And they have been quietly positioning while the headlines called silver a relic. The mainstream has not caught on. The pension funds are not in this. The financial media is still treating silver as a sideshow to gold. And that is the gift. Because by the time this is obvious, by the time silver leads every news segment and every advisor at every firm is recommending it, the easy part will already be behind us. Nobody sends you an invitation to be early. There is no bell that rings. The whole point is to understand the base before the crowd understands the breakout. And right now, you are ahead of the crowd. That is not a feeling. That is a position. Which is exactly why I want to make you an offer for taking this seriously and watching all the way to the end. If you have $100,000 or more in a retirement account, I am hosting a free one-on-one, no obligation educational web conference where we walk through your specific situation. how much of your savings might reasonably belong in physical metal, and how the self-directed IRA process actually works. It is genuinely educational, not a sales trap. And the honest reason to do it now is not fake urgency. It is the opposite. The best time to make a calm, clear-eyed decision about protecting what you built is exactly when nothing feels like an emergency, when the base has just broken but the crowd has not arrived, when you still have room to think. To take me up on it, mention that you watched this all the way through. If you are on your TV, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. So let me close where we began, with that ceiling and that man in his chair beside a safe full of silver. For 45 years, the market told him he was a fool. For 45 years, the boredom did its work, wearing down every weak hand, absorbing every doubt, tightening the physical world one deficit year at a time. And then, in his old age, the metal finally climbed above the price he paid when he was young, and the base was finished. That is the warning silver just sent. Not that something is about to break, but that something already did, quietly, after the longest wait any major market has ever asked of the people who believed in it. The bigger the base, the bigger the move. This is the biggest base I had ever seen, and you are standing at the very beginning of what comes after it, early, while it is still cheap and still quiet. Nobody is going to call you and tell you the wait is over, so consider this the call.